It has been a decade since some of the most jaw-dropping, smoking gun evidence about personal finance in Canada was released, yet most people are unaware of the problem. In 2016, an academic paper entitled The Misguided Beliefs of Financial Advisors was released. And this may be the first time you've heard about it, and that's extremely embarrassing for the Canadian mutual fund industry. You can't be outraged by things you're oblivious to. The research showed that Canadian mutual fund registrants were doing three things wrong. They were chasing past performance. They were loading up on things that were doing really well over the past 1, 3, 5 years, even though all the prospectuses and all of the evidence show that you should not be relying on past performance to make decisions going forward. They were not paying any attention to product costs, even though virtually everyone knows that product cost correlates negatively with performance and that the lowest cost products are usually the best, all else being equal. And they ran concentrated positions. They would buy 2, 3, 4, 5 different funds in the same asset class because they were in an asset class that was hot, and forgetting about proper diversification, which is really the only real free lunch in investing. Now, all three of these transgressions run contrary to basic personal finance principles, and they're understood by everyone. So specifically, almost everyone knows that past performance doesn't necessarily persist and should not be relied upon. It's literally on every prospectus and fund facts document. Almost everyone knows that cost is a major determinant of performance and that the relationship is inverse. You get what you don't pay for. And almost everyone agrees that diversification is the closest thing to a free lunch, as I said. Harry Markowitz won the Nobel Prize for this, finding out that optimizing risk-adjusted returns was the best way to build portfolios. Believe it or not, it gets worse. Mutual fund registrants were shown to make these own goal mistakes even with their own accounts and even after they had retired from the business. The misguided beliefs problem, therefore, is not based on misplaced agency or ulterior motives because the evidence is clear that advisors honestly believe their advice is sound. How is this possible? And what can we do about it? So I wrote a book about this called Stand Up to the Financial Services Industry in 2019 to ring the alarm. It was mostly ignored, but to this day I believe the problem persists and that it poses a serious threat to ordinary retail investors. It seems the best explanation for this problem is rooted in social psychology. Think of Stanley Milgram's work on obedience, or Solomon Asch's work on conformity, or Leon Festinger's work on cognitive dissonance. It looks like the best explanation for the problem is old-fashioned peer pressure. Imagine a world where advisors just want to fit in, and so they do what everyone else does. And once a pattern is established, it becomes a norm, and that's difficult to dislodge. Imagine advisors as unwitting conformists, not independent critical thinkers. In 2016, a more common term for this mindset would be useful idiots, a term that implies people are being used or exploited by others rather than acting with full awareness or intent. And at this point, I think it's important to distinguish between misinformation, which is an honest mistake, and disinformation, which is a deliberately false attempt to manipulate someone. It seems our mutual fund registrants, and there are nearly 4 mutual fund registrants for every securities registrant in Canada, are being bamboozled by an industry through a two-step process. First, product manufacturers and distributors cause them to believe things that are demonstrably untrue, that's the disinformation, and then they unwittingly parrot that mindset to their clients, which is misinformation. For the past few months, I've been giving lectures at colleges and universities throughout Southern Ontario to alert them to this problem. I call it pre-bunking. I ask at the beginning of the lecture if they see any similarities between the people who attacked the U.S. Capitol on January 6, 2021, and the people who give advice on mutual funds. At first, almost no one sees any similarity. But I go on to point out that both normalize misinformation, both are or were groomed by their bosses to do their bidding, both honestly believe they're doing the right thing, both dismiss counter-arguments when confronted, and both use motivated reasoning and tribalism, not critical thinking and evidence. And after I point all this out, most students change their vote. Remember, these are people who want to work in the personal finance space one day. We all need to use better decision hygiene. We need to focus on facts and not let false narratives supported by unthinking repetition persuade us. We need to look for trusted sources of information. Until now, regulators have done essentially nothing to disabuse mutual fund registrants of their misguided beliefs. The industry's fat and happy and making money, and no one's complaining about the problem. I'll repeat the obvious flaw in the logic. No one ever complained about an injustice that they were oblivious to. It seems virtually all mutual fund advisors need to be retrained. It might even be more accurate to say they need to be deprogrammed and then reprogrammed. What should have been a proper education seems to have been a de facto indoctrination. Given all of this is going on in the world, I believe the Overton window is now open. And that's a term used to explain political opportunity for change. It categorizes the range of initiatives that are politically acceptable in the mainstream population at any given time. Things that were once seen as radical can be reconsidered to be seen as self-evident in the fullness of time. The need to combat biased information has never been more urgent. Preparation and training for mutual fund advisors is moving to a competency-based exam framework going forward, and the exam will be run by CIRO. At a minimum, it should pick up on some of these misconceptions, which have remained egregiously unaddressed for nearly a decade already. Please write to the industry regulator, the Canadian Investment Regulatory Organization, CIRO, and or the Trade Association and Lobby Group, which is the Securities and Investment Management Association, SEMA, to demand meaningful consumer protection. Insist that they do better. The mutual fund industry has been gaslighting you for years. They know it, but they've done nothing concrete to correct long-standing and systemic misconceptions. Astonishingly, it seems as though through all of this, their representatives haven't even had a clue. Advisors have been the hapless enablers of corporate profit at the expense of consumer protection.